Michael Batnick, welcome to the Long-Term Investor.
Thank you for having me.
I could not think of a better guest to have today because what I want to do is talk about the year that we're just about to finish up, 2024. And one of the things that you've gotten in a habit of the past few years, and I'm guessing you're going to do it next year, is that you make some predictions. And I know you're not like thinking you're going to perfectly predict the future and profit off of it, but maybe just tell our listeners a little bit about what you're thinking behind doing those are.
All right, a few reasons. Yeah, you're right. I'm not necessarily acting off of these predictions. I do it because it's fun. I do it to hold myself accountable. I do it as a reminder of that predicting the future is impossible. And let's be honest, I do it because it's content and I've got a podcast and it gives me something to talk about. If I was not in this industry, if I was not creating content, would I do this? Certainly not.
Yeah, that's fair. And you had the managing director of Ritholtz Wealth Management. They're from basically the very beginning. Co-host of Animal Spirits, co-host of The Compound and Friends. You guys have a lot of other spin-off shows, so I'm not really doing it you full justice. But one of the things that I appreciate about what you and your colleagues do is you do put out a view constantly. And, you know, the end message is typically something like stay the course. And I always feel like there's a lot of value, not necessarily in every single advisor having their finger on the pulse of the market, but at least the firm having somebody there to do that. And sometimes I think that advisors these days, as investment strategies have rightfully so become more passive or rules-based, you know, I'm not sure that investors really place that much emphasis on knowing what's going on with markets. I mean, how do you feel about that?
Well, the number of CFA charter holders sitting for an exam versus the number of CFPs has completely flipped, as well it should. Right? Because the days of alpha or selling alpha or, let's be honest, delivering alpha are a thing of the past if they were ever a thing at all. And they used to be a thing. Let's give credit where credit is due. But the value that advisors deliver to their clients, in my estimation, or at least in my opinion, is, okay, I've worked hard, I've saved money, I've got goals. Am I going to be able to do those things? And what is the best way to implement those strategies? Like at a high level, that's what we do. And the investing component is but a small but important piece of it.
Yeah, definitely. If you look at the pot, like a pie chart of what people in our profession did 20 years ago, you know, it was almost all investing and no planning. Now the pie, I would say, is more planning than investing. Mm-hmm. You know, I always feel like even though the message is stay the course, having a sense of history, having a sense of putting context into things is very valuable. And so to all the advisors listening today, you're going to get to use Michael's insights on 2024 to help you write your year-end newsletters. So they're just going to straight rip you off here. And I thought I might run through some headlines from the past year, just kind of get some of your instant reactions. That sound good to you?
Sure. What's happened?
All right. So I'm going to start in January. The Fed held rates steady at the January meeting. They're saying there's concerns about inflation, which remained above target, but was showing signs of cooling. I sort of remember going into the year, and maybe your memory is different, that everyone was pricing in like 6 or 7 rate cuts. In that January meeting, the Fed's like, hold your horses. Inflation's still a little high. And we saw bond yields go up, bond prices go down. I don't know. For me, when I think about a lot of that period of time, as well as even now, to me, it still feels like people are really anchored to that zero interest rate period. And I just don't see interest rates settling back where people are anchored. How are you making sense of what the Fed is doing today and what your memory was of back then?
So going into 2022, it was consensus that the Fed was going to manufacture a recession. And despite their best efforts, they weren't able to do it because we were flush with cash. And in that scenario, we're not going to not spend. And so they jacked up interest rates in hopes of slowing down the economy, cooling inflation. Everybody was bearish. And the financial markets had a really tough year. Of course, bond prices got destroyed, not giving ballast to a 60-40 portfolio, but dragging it down, right? As interest rates went up, fears abound, and tech stocks got crushed. And 2022 was a really tough year. I think people forget. They act as if it's been up only, and this has been a really easy one-way bull market, and that just could not be farther from the truth. And then heading into 2023, so we had the low in October 2022, and I remember, and I've said the story, but it bears repeating. I was in a room full of investors, and I said, "Hand up if you think that was the bottom." Nobody raised their hand. Hand up if you think there's going to be a recession next year. every hand in the room went up. And so everybody was positioned for 2023 to be a really rough year. And lo and behold, tech stocks bottomed on December 30th or December 31st. And it was up only. And a lot of that is because the narrative changed. Why? Because the facts changed. We had ChatGPT and this whole wave of enthusiasm of something that was completely unforeseen and unpredictable and probably did save us from a recession or a longer bear market. And so 2023, you had all those things. And as we looked forward to 2024, we said, okay, now, mission accomplished. We landed the plane, and I say we, I mean the consumers. I don't think the Fed. I think we didn't crash despite their best efforts to do so, and we were up like 20-something% in 2023. And who had on their bingo card that we were going to be up 29% in 2024? Not me, and not many other people either. You look at like the average Wall Street strategist had a negative price target for the year, which is unheard of. I think that's literally never happened before. And so when everybody was on one side of the ship, it steered a different direction. So to your point about like interest rates and anchoring to ZIRP, I don't really get that sense. I think that a lot of misallocation and damage was done in that era. And I think we're seeing some of the side effects from that still to today. But the interest rate trajectory is interesting, probably more so from the view of like the housing market more than the stock market at this point.
Yeah, if you don't own a home, you're upset. If you do, maybe you don't really care unless you want to move. But I mean, in general, I feel like the Fed has, in interest rates in general, have probably gotten more attention from the average investor, or I should maybe even say average consumer, than normal. I mean, if I'm looking at what the Fed did in 2020 to present, where we had a crisis unlike any of us have really lived through, a crisis of health, not just, financial markets, shut down the whole economy, all the things, to inflation. I came out of school probably a similar time as you, and there wasn't inflation. 3% inflation is super normal, but people are like, any inflation are freaking the heck out. So, I mean, in your perspective, if you were going to like grade the Fed on how they've done since the pandemic through the present, what kind of grade are you giving them?
Yeah, so I think that the Fed has a very difficult job, very important job, but I don't think they did a great job. I don't think that history will be too kind to them. In my estimation, they were very late to raise rates to identify that the inflation was more than transitory, and at a time where we had the Inflation Reduction Act. Oh my God, LOL.
Right.
And all that fiscal stimulus. And then the mortgage bond buying on top of all of it, when housing prices were going up 20% every week, it seemed, and this is not revisionist history, Josh and I were young about this at the time, what are they doing? Like, do they know something that we're not seeing? Like, it seems very apparent that they should not be doing what they're doing. And then after that, they were way too late to cut rates. And so I think that they tried to crash the economy and they couldn't. And then they kept us above what I think was an appropriate level for too long. Now, listen, it's easy to be an armchair quarterback, right? So like, I don't want to like be too hard on them, but no, I don't think they did a great job.
Yeah, I'm with you. And the history books, I mean, I don't know if a history book says they were 6 months late and you're looking at like a 20-year period. Is that late or is that like good enough? I'm not enough of a Fed student to know. Truly.
I mean, well, also they will get credit for the AI that had nothing to do with them. Like, right. I think that honestly saved the market. And so had we had a hard landing, I think, but we'll never know like the alternate paths.
Well, so that's a good transition. As I look at like headlines, all right, so the Fed eventually cuts rates in March 2024, but NVIDIA, chip maker for all things AI, hits record high at about the same time. I think in March, and I was looking back at one of my blog posts, just seeing like, I think this was the point in time where the common investor probably had not heard of NVIDIA or understood the difference in types of chips. When they thought chips, they just thought of like what Intel was making. But, at this point in time, the people are like, wow, there's some big returns. Obviously, you get that hindsight bias. Obviously, this was going to be a big deal. Let me ask you this. If you have cash today, are you buying NVIDIA?
I'm not buying NVIDIA, no.
You already own 5 or 6% in the total market index.
Yeah, listen, if you're an investor, you own NVIDIA and you are certainly exposed to NVIDIA. Interestingly, NVIDIA, the stock put in a top a couple of weeks ago, but if you look at it relative to like its competitors, if you divide NVIDIA by SMH, that certainly looks like a blow off top. Meaning like it went vertical, and it has since pulled back sharply. Whether or not that comes to fruition and that was like a local top or a longer term top, obviously who the heck knows? That's not a game that I necessarily play, but I am, embarrassingly enough, I never bought NVIDIA, the individual stock. And I do buy individual stocks for myself in one of my IRA accounts because I enjoy it. It gives me entertainment. It gives me, again, content for the show. I'm under no delusion that I'm going to beat the market or that it's going to impact my financial livelihood at all. But it's something that I love to do, so I do it.
Well, so let me ask you this. I know, well, I shouldn't say I know. Let me speak from my own experience that when a stranger asks me about buying individual stocks, I'm usually like, hey, just put in an index fund, especially if I don't know them. It's really safe advice. But if you have a client coming to you, they know that you talk about individual stocks on the shows, on your blog. Like, how do you talk people through investing in individual stocks, the expectations, the risks, et cetera?
Okay. So I had a handyman in here the other day, and he sees my screen and he goes, "Lane, let me ask you something. You're in the market?" "Yeah, I'm in the market." "If you had $50,000 to invest, what would you do?" And I'm like, "Well, give me more. Like, what are you trying to do?" He's like, "Well, just earn some income." I'm like, "All right, well, so let me tell you this, the scenario here. The risk-free rate, I point to the 10-year, is 4.2%. So if you're looking for income, you can get 4.2% risk-free guaranteed by the U.S. Treasury. And when I say risk-free, that means that you'll get your money, you'll get your interest payments, you get your money back. It's not risk-free in the sense of like there won't be price swings and inflation can't erode it away, but that's the benchmark. If you want more than 4.2%, because he's like, 4.2. Well, if you want more than 4.2, there's all sorts of different risks that you're going to be taking. He's like, okay, yeah, that's not that interesting. What about like a Tesla? I'm like, oh boy. So the question is, of course, like what type of money are we talking about? What are your objectives? If you are like a speculator gambler and this is like, listen, I do the right things. I eat my meat and potatoes, fruits and vegetables, whatever, my 401k, and I like to have fun and dabble. That's a completely different story. Now, I will never give individual stock advice. I've been there, done that, and I can't see the future. I don't know about these companies any more than you do, right? If somebody's asking me. So I'll talk to them about like regret minimization and risk management. And we know from the data that, and this is from JP Morgan's Agony and the Ecstasy of the Markets, we know that 40% of all stocks in the Russell 3000 experience a 70% crash from which they never recover. We know that 2% of all stocks, or maybe even less, are responsible for all the returns in the market over time. We know that most stocks don't beat inflation, don't beat treasury bills. We know that most stocks are not worth owning for the long run, even though we believe in stocks for the long run. So if we know all that, there's got to be some sort of acknowledgement that it's probably not a great use of your time or your money. And so just do with that what you will. So make it a small dollar amount. And like, if you say, hey, listen, and this is probably giving people too much credit, too much benefit of the doubt. I do this to remind myself why I should own index funds. Phenomenal. I do this to have fun. I do this to speculate. I do this to gamble for whatever reason. And it's 5% of my portfolio. Have at it by all means.
Yeah, I like that point of view. I'm in a pretty similar point. I did when I came to PlanCorp swear off individual stocks, and I got real tempted in 2020 when it looked like some things were going out of business. That's when it's actually hard to stay away. Day to day, I don't feel the temptation, but maybe it's because I'm too busy. But talking about temptation, and I'm still looking through these headlines. And by the way, if you're listening or watching us, I'm going to put the whole like slew of headlines, even the ones I'm glazing over and not mentioning. I'm going to put them on the show notes at thelongterminvestor.com. But how can we not talk about when the spot price Bitcoin ETF finally comes to market? I remember listening to a couple of your shows, and you were like super bullish on these being able to attract assets, and you were right. Looking back on these product launches, how do you feel like it's played into Bitcoin or crypto as a whole throughout 2024?
So, Peter, I've never said this out loud, but it's kind of funny that my biggest conviction bet ever has been Bitcoin. And and it's not even something that I necessarily like air quote believe in. I'm not one of these people that like self-sovereign store of value, replace a dollar inflation hedge. I don't believe any of that. But what I do believe is I do believe that they believe, and I did believe, and I still do believe that this was for me, from the investment perspective, it was merely a supply demand story, an adoption story, period. And so I thought that the ETF passage was inevitable. And I didn't think that there was going to be a run up into that. And as a result of that, and I thought that this would feed on itself and that the institutions were coming. And so it was really, for me, it was nothing more complicated than that.
Yeah, that makes sense. And I've published a lot on it, maybe not as much as you have. And I've been riding the fence the whole time. Like, I haven't been willing to take a real view. I've been more like willing to poke holes in what I feel like are really dumb arguments for it. Because there were a lot of really, really dumb arguments, and there still sort of are. And one of the things that was interesting, so I don't know if you remember Jason Zweig at like an evidence-based investing conference forever ago that you guys were putting on. He had talked about like, yeah, it's probably worth nothing or a ton, in between. And I had him on the show a few weeks ago, and I was like, so what do you think? Is it worth a ton now? Because $100,000, that's a lot. Like, there are a lot of people who've made a lot of money. I do sort of worry about expectations for people who jump in now, but the ETF makes it simpler, at least. Less likely you're going to lose like a password or something.
Yeah. I mean, for people that are like, should I buy now? It's like, come on.
Like, why? Like, it's fine if you want to, but what's your reason, and is it a good reason?
Right.
And
so
I don't know what a good reason is at this point. And I'm not saying there isn't one. I just not sure I recognize what it is.
No, the good reason is you're afraid of missing out on further gains. Like, that's it. But it's up 40% of the last month. It's up 80% of the last 6 months or something like that. Like, if you want to own Bitcoin, listen, I get it. I do own Bitcoin. But if you're like FOMOing.
Yeah, but you're a long time holder, so it's a little different.
Yeah. If you're FOMOing now because you're afraid of missing out, like, that certainly makes me want to sell, if anything,
Yeah. I mean, it's not an unreasonable thought. Slowly working through the calendar, I'm looking at April 2024. I'm seeing tech giants report record earnings. You'd sort of mentioned it earlier. It sort of feels like AI rode to the rescue in November of was it 22 or 23?
It was 22.
Yeah, ChatGPT came out, and actually Sam Altman tells a story about how like when they were going to release, he didn't realize it was going to release. And the reason it's called ChatGPT is someone like texted him being like, what should we call this thing? And this was supposed to be an internal name, and it just they never really branded it. And so here we are. But it was around April when a lot of the headlines and people started coming out talking about like, wait, is the market too concentrated? Give me your thoughts. What do you think about market concentration at this point in S&P 500?
Yeah, I would say be careful what you wish for, because concentration is a feature of bull markets, and the unconcentrating of indexes happens in a bear market. So I would share the concerns to the extent that there are concerns if these companies were not justifying their premium multiple, their percentage of the index is justified based on fundamentals. There's not some sort of conspiracy. It's not money printing. It's not the Fed propping it up. These companies are earning the lion's share of the profits. And so it's not surprising that they're going to be a big portion of the index. So I'm not concerned. Would I prefer, I guess, a more broadly diversified market? Like, I suppose intuitively that makes sense, but given that the data doesn't suggest it, no, I'm not concerned. And earlier in 23, yes, the Mag 7 was providing a gigantic portion of the index. And same thing in early 24. And Josh and I spoke a lot about this. I would have been nervous if the rest of the market was melting down and it was only these giants that were propping up the index. That wasn't happening. The rest of the market, if you look at the equal weight, was sort of going sideways while these were chugging higher. If the RSP was crashing and the market cap weighted was going up, yes, that would have been like, oh, we saw that in 2000. That would have been worrisome, but that wasn't the case. And so I wasn't worried, and it's not something that I spent a whole lot of time worrying about.
Well said. I got a lot of stuff on that I'll link into the show notes at thelongterminvestor.com. As I keep going down through the timeline, another headline I see in May 24. So Fed Reserve signals potential rate hikes. So it's a big like, oops, did we cut too soon moment. We did start a little bit of a sell-off later. Actually, let me move to the next one. So there's like US-China trade tensions escalate. And basically all economists agree that tariffs suck. Seems like maybe more on the way, which just increases prices to consumers. I'm not like trying to tackle this from a political standpoint. I'm just saying, like, do you think at all about tariffs? Let me start there.
Not a whole lot. I mean, I don't get what they're doing, what he's doing. I mean, I get like why he's doing it, but it doesn't seem to make economic sense. I don't think that there are any economists on either side of the aisle that think it's a great idea. But is this something that I spent a lot of time thinking about? I don't know. I mean, I'm sure there will be flare-ups and like it's going to raise prices for individual items, and I don't get it.
It's got to have already been like factored into market prices. It just may be that like how about this? Tariffs, maybe the idea of tariffs coming down the pike or more tariffs coming down the pike are already incorporated in market prices, but they aren't necessarily incorporated in consumer expectations about, their future spending.
Yeah, I think that's probably right.
Okay. Not a super interesting point, but I feel like we're hearing so much about tariffs. I see let's see, I'm skipping over June. I'm looking at July, the shift from tech to small cap stocks. So kind of what you were talking about earlier, you start to see a little broadening. And is it fair to say it's like never been more difficult to be a diversified investor?
Yep.
I mean, in my whole career, we could have just bought the S&P 500 the whole time and looked really smart, but yet I would like to think we are smart and we're globally diversified and like own other stuff. I mean, I feel like the type of investor that typically calls into me is a do-it-yourself investor, and they're always owning a lot of ETI and VOO. Since they're probably tired of hearing my voice on the topic, well, what do you tell these people who are U.S. heavy at this point?
Oh boy, Peter, this is not an easy one because I do believe in cyclicality. I do believe in global diversification, but I also do believe that investors respond to forget about the last 15 years, the last 5 years, the last 3 years, the last 10 years. And of course, the question is like, do the valuation spreads make it compelling enough to own things other than the S&P 500? And I just don't think it's great to put all your eggs in one basket, despite the fact that it's been the best, strongest, sturdiest basket. So where that dial is appropriate for you, I'll leave that up to the end listener and their advisor. But I still think it makes sense to diversify because you don't know what the future holds, and stocks are trading rich. I'm not saying, they've deserved the rich valuation. But is this going to continue forever? I don't know. I hope so. I mean, I wouldn't be mad if the U.S. just outperforms forever. It would make my life a little bit more difficult, but it'd also be,
It'd probably net be good for us.
Yeah, I don't know. I'm talking in circles because I don't know the answer. It's hard. I can't see the future. I wish I could make my job a lot easier. We don't know that the future is going to look like the past in any shape or form, but that's what diversification is for. And if you believe that the future is uncertain, you diversify. And if you believe that you can see the future, then you concentrate, I guess. And good luck.
Yeah, I think one of the most detrimental voices or things said by a really influential, great voice was Warren Buffett when he told the world, all I'm going to own is the S&P 500 in my estate. And it's like, well, cool. You have billions of dollars. You can sit through long periods of time in which U.S. stocks trail everything else. I have on screen 3 periods in which U.S. stocks lost to cash, one of which wasn't that long ago. From 2000 to 2012, cash beat the S&P 500. There's a 17-year period that started 1966 to 1982. There's another 15-year period from 1929 to 1943. I kind of share the numbers because, like, when something happens like that historically, it means something like it's probably going to happen again at some point for some period of time. What I don't know for people who own or who have really sat in only U.S. stocks for the last 15, 16, 17 years, yes, I realize you're making more money. It is super hard to stick with that strategy if it's losing for 10 years, just like value investors have struggled to stick with value. All right, enough of that. The Federal Reserve in August, they signaled rate cuts. So there was the oops, did we cut too soon? Now they're saying we actually do need to cut. This was in August 24. S&P 500 had an 8.5% pullback. I had the market's down 10% email queued up and ready to go because I was supposed to travel that week. Did not have to hit send. Let me ask you this. I mean, I'm looking when I go into September when the Fed actually cuts rates. Why don't we make you have a prediction? Maybe you're already working on your prediction post, but where do you think rates go in 2025?
That's a good question. Let's say like 4%. I don't know.
Sure.
Couple more cuts. Sound reasonable?
Why not? It's a good time to be a saver. I feel like the homeowners, you made the point, like most of this seems to be impacting homeowners more than investors, or at least people probably notice more with their mortgage or their ability to get a car loan or whatever than they are noticing their bond market performance. Except for 2022, everybody definitely seemed to notice that their bonds were down. But in general, I don't know what the Fed's doing. I'm not sure the Fed knows what they're doing.
No, they don't.
The dot plot, I know the year that they raised interest rates aggressively, they didn't even have any interest rates on the dot plot, right?
They can't see the future any better than you or I can. So like I said, they're trying their best. They're reacting to the data. The data changes and the world changes, and so they're trying to adjust as they deem appropriate.
You sound way more positive than I do, and that is my intention. So let's listen to Michael, everybody, and not me. You can't do a 2024 review without talking about a presidential election. I don't really love talking about politics, but every 4 years, I kind of queue up the same messages for clients because there's a number of people who think that the world is ending based on whoever is in office. How do you think about this cycle that tends to keep showing itself over this cycle in emotions, not necessarily markets that keeps showing up?
Yeah, every 4 years you have people that think that the world is going to change dramatically. I was about to say end, but I don't think people go that far. That the market is going to do something because the person that they didn't vote for is in the White House, and the president is important, of course. It matters for certain industries, certain jobs, certain sectors. But I think the way that I describe it, the role of the president in regards to the market is they're like a manager of a baseball team. The players matter a lot more. So the players being Apple, Microsoft, ultimately earnings drive the market, margins drive the market, and there can and will be noise and distractions, whether it's from this president or any president. But the beat goes on. It just is a giant distraction, and you could do all that you can with numbers and graphs, but like this is an emotional topic. It's not really a numbers topic. So you got to. I think when we're talking to people that are upset based on who's in the White House, whether they voted for them or not, it's just like, listen, I get it, right? But like, let's refocus our energy to like, you can't control it, you can't predict it. If you want to downshift because you're nervous, like fine, like it's a lot better than going to cash, right? If you need to go from 60-40 to 60-50 to 50-50, let's do that. But this is why we plan, right? Like this is why we have a financial plan in the first place. It's to deal with the fact that markets are uncertain, the future is uncertain, but you got to chart a course that can survive, blue skies and gray skies and everything in between.
I'm with you 100%. Feels like the end of every episode that I ever have done or any blog post I've ever written. I feel like I was always just telling people like, hey, do you think like McDonald's is going to try to sell less cheeseburgers or right. Coca-Cola is going to sell less soda? At the end of the day, when you look at those long-term charts, it's always, I'm even surprised when I see it that stock prices follow earnings over the long run. And so when you invest in the stock market, you're sort of making a bet that humans like money. The people running these companies like money, and they're going to try to find ways to make more of it. And
that's it.
That's the
Stop.
bet.
That's it.
Yeah. Are you going to do predictions for 2025?
I am. They're kind of a pain in the ass, and it's a lot of work, and I don't necessarily get a lot out of it. So like, I was thinking about just mailing it, but I'm going to do it.
Anything that you could share in advance? Or directionally, what are things you're thinking about or considering memorializing?
Yeah, so I think that the triple levered MicroStrategy ETFs will have a blow up. And I don't even know that MicroStrategy has to blow up for these to blow up.
Right. It's insane that stuff like that exists.
Right. So
for people who don't know what he's talking about, like MicroStrategy is a company that has used its balance sheet to buy Bitcoin, basically leveraging the company's balance sheet. And as Bitcoin has gone up, the balance sheet of this company has gone up, and as a result, the stock price has gone up. And there's so many single stock ETFs these days, which I'm going to be honest, I don't really understand. Maybe you could explain to me why someone would want a single stock in an ETF rather than the stock itself. Maybe I've just missed the boat on.
It's just leverage.
It's just only leverage piece. Yeah. So lever up instead of taking margin yourself.
Yep.
I learned how leverage worked the hard way sometime coming out of the financial crisis where I was trying to rebalance and I needed more mid cap. And so I bought a 2X mid cap fund thinking I was smart. And that's how I learned how leverage worked. It does not just, it's not plus or minus the two returns. That compounding gets you. Fortunately, I had no money when I came out of school. So I think I probably lost like all of $800.
To that point, like we mentioned earlier about single stocks and stuff, I don't give people advice because it's a lose-lose. Either you give them advice on a single security or idea and it goes up and it was their idea, right? They incept the idea, or it goes down and you're an asshole. So like I avoid that like the plague. I've learned that lesson the hard way.
All right. So MicroStrategies are going to blow up. Anything else you can give me?
The levered ETF. I'm not.
Sorry. Yeah.
Anything else? I think the market's gonna be down next year.
Why not? Yeah. We've had a great run. If we are down, 10% drops. I don't know. Doesn't the data say 10% drops happen on average every 12 months? Obviously, not every calendar year, but it seems like a reasonable.
Yeah, I think that the momentum is very strong. The wind is at our backs, and I think, and I'm again using air quotes because like, would I bet on this outcome? No, of course not, because I'm not a crazy person. But like I air quote think that the market will continue to rally in the first half of the year, and there'll be something that knocks us off track, and there'll be a pullback, and we'll end the year slightly negative. That's what I'm going to put it in.
All right, cool. You're pretty good on recommendations. I feel like I have no cultural capital in these things. Anything book, movie, TV that you're excited for in 2025?
Yeah, TV's back. There was certainly a lull thanks to the writer's strike. I'm really excited about White Lotus.
They have a new one coming out in
season
25?
3. I don't know
Nice.
when does it come out? January, or is the Severance comes out in January?
Ooh,
White Lotus,
that'll be good too.
Yes. When does this come out? But the last one, February. The last one, season 2 was like a while ago.
Yeah, it was.
Right? Like it was like 2 or 3 years ago.
I binged 1 and 2 at the same time. I think I binged them both when season 2 came out.
Which
it was
prefer?
over a year ago for sure.
Which did you prefer?
That's a great question. I think, man, the first one was so weird. I think the second one, I think I was so thrown by the first one. And I gotta admit, I don't watch a ton of TV. And I do a lot of I'll watch the first season of something awesome that everybody agrees is great. And then for whatever reason, I just don't keep going.
That's usually the right call.
Yeah. Yeah, because no one expects to go past one season. The Bear was awesome in season 1.
Yeah.
It was okay in season 2. I didn't continue onward. But then there's stuff like Succession where I jumped on late, and as a result, I blew through the whole thing. So it's kind of about
That's
when
not a
do
bad
I get into
strategy.
the life cycle in general.
Yeah, not a bad strategy.
Yeah. Okay, so White Lotus, Severance, anything else?
Yeah,
Book-wise, I don't know what else is coming out book-wise next year myself. I'm supposed to.
I don't do books anymore. There's not enough time.
Too
in the
busy.
day.
Yeah,
Too
yeah.
busy for that. There's a new James Gunn is doing a new Superman reboot. I'm excited about that. I love the Jurassic Park series, even though they're terrible movies at this point. So I'm less excited than I would have been. What else is coming out? Mission Impossible is next year. There's a new Avatar next year. It's all
I
the
can't believe
same.
there's more Mission Impossible. I'll
It's
go
all-
see
it's all
Avatar.
the
That's
same.
like a movie theater only situation, I think.
Yeah. It's more the same, more horror, more genre stuff. So
Cool. Well, Michael, I gave you some big praise in the introduction, just in case people forgot what I said. Where can they find you? What's the best way to follow along with you?
Oh, thank you. Probably the podcast Animal Spirits and the Compound and Friends.
Yeah, 2 of my favorites. Everybody who's listening, go to the longterminvestor.com. You'll get detailed show notes. You'll find links to all of Michael's work. Michael, thanks so much for joining the show, and look forward to seeing you again soon.
My pleasure, Peter. Thank you for having me.